Now we're going to talk about the subsequent measurement cost and the revaluation model, right? And when we talk about the subsequent measurement, so when you look at the accounting for fixed asset, as I said, the fixed asset are either purchased or you're doing the construction of a fixed asset, right? So you keep on incurring cost. You keep on incurring cost. So that is what is a historical cost model, right? However, the accounting standard allows you that you not only look at the historical cost, but you can also do accounting for this under the fair value model, okay? So now we're going to try and understand that how do you account for fixed asset under the historical cost model and then under the fair value model, right? Both the models we will try and understand, and then how this is going to impact this from the perspective of depreciation accounting, what disclosures I need to look at, how do you look at the increase in value of fixed asset on account of change in fair value, how you look at decrease in fair value of asset, right? All of that is what we will try and understand as part of this section. So when I look at the subsequent measurement thing, there are two components, as I said, which is the cost model as well as the revaluation model, right? So in the cost model, I'm going to look at the accumulated depreciation and I'm going to look at the impairment. So there are two potential things. One is the gross carrying amount. Now the gross carrying amount, I'll have against the gross carrying amount, I'll have the depreciation, and also there could be situation that you may have impairment, right? So we need to understand both of them. Now, when I'm looking at revaluation model, okay, when I'm looking at a revaluation model, I have a revalued amount, which is the fair value when I'm doing the revaluation. And then again, I have the accumulated depreciation and I have the accumulated impairment loss. Now, the fundamental thing what you need to remember here, that first of all, revaluation model is very rare, okay? We don't see that in practice. Very few companies, in India, you can count those companies possibly, on fingers if they were doing it. There are no such company actually which follows fair value accounting, and globally there are very few companies, who follow fair value accounting, and they only do it because of other nuances, for example, certain debt covenants or certain other reasons, right, which are very, very specific to that company. Otherwise, across the board, we see is the cost model is what is being followed by companies in relation to accounting. So this is the most prevalent method, is what is in a way being followed by companies for the purpose of accounting for fixed assets. So initial recognition and then the subsequent measurement. For subsequent measurement also, across the board we see is companies are using cost model, but the standard permits you to also use fair value model or a revaluation model for the purpose of doing the accounting. Now, if you are doing revaluation model as the manner of accounting, then you need to apply it consistently, and we will talk a lot more about it. But the depreciation expense on the revalued amount is what is charged to the profit and loss account. So ordinarily, if there is an increase in the value of the asset, then the depreciation charge in your P&L will be higher if you are following the revaluation model. And if you are following the cost model, and if you follow, let's say, straight line method of depreciation, then the depreciation charge in the P&L will be even out over the entire period of the life of that asset. So it will be the same depreciation cost in each of the accounting period. Now we will try and understand as to how you deal with depreciation, right? So what's the fundamental assumption for items of property, plant and equipment except land, right? Now, land is not considered as a depreciable asset, but if it is a leasehold land with a definitive life that you need to give it back to the landlord, and you don't have the ability to convert that into a freehold land, then that leasehold land is also required to be depreciated, okay? Now we need to understand that leasehold land, now under the new guidance, it may go into Ind AS 116 under the right of use asset. So it may not get accounted for under Ind AS 16. If it is a leasehold land, you may account for this under Ind AS 116. But let's say if it is a freehold land, then it gets accounted for under Ind AS 16, and you don't need to provide depreciation on a freehold land. And every other item of tangible asset, whether it is plant and machinery, building, furniture, fixtures, vehicles, and anything else, right, which is out there, all of it required to be depreciated using an appropriate method of depreciation. Again, Ind AS doesn't specify that this is the method is what you need to use. It simply says a method which appropriately represent the usage of such asset is what is required to be used for the purpose of depreciation. So all assets with a finite useful life must be depreciated, and depreciation begins when the asset is available for use. Now this is also very, very important for you to understand. It is depreciation begin when the asset is available for use and continues until the asset is derecognized or classified as held for sale. So the moment you classify an asset as held for sale, then you stop providing for depreciation on such asset class, right? So again, it is, and you know the accounting for asset once it is classified as held for sale. We talked about this in some of the examples previously. Then it goes into Ind AS 105, and we will cover that in more detail as to how do you account for assets which are classified as held for sale. But the depreciation on asset begins, right, when they are classified, when they are available for use, right? So there is a distinction between available for use and put to use, right? So I have an asset which is available for use, but I'm not using it, right? Now if you're not using it, doesn't mean that you're not supposed to provide depreciation. The moment the asset is available for use in the condition and location it is supposed to be made available, if it is available, then you need to provide depreciation on that. There is no exception. There is no exception to that rule. The once it is available for use, you need to start providing for depreciation from that day onward over its estimated useful life, after factoring in the residual amount if there is any in relation to that asset. And you got to also appropriately determine the amount of depreciation. The method of depreciation is what you're going to use. So what is the definition of available for use? Is when the asset is in the location and condition necessary for it to be capable of operating in the manner intended by the management. So again, as I said, it is important for you to register that it is to be depreciated from the date it is available for use and not from the date when it is put to use, right? And this distinction is very, very important again for you to understand. Now, how do you determine the useful life of assets, right? So what are the factors which needs to be considered for the purpose of determining the useful life of the asset? And again, these are fairly standard and similar to what you looked at under AS 6 accounting standard 6 model as well, which is what is the expected usage of the asset, what is the expected wear and tear of the asset depending upon the operational factors, the technical or commercial obsolescence arising from improvement in production or change in market demand of the product, legal or other limits which are placed on such asset management policy of the companies to say that, I'm not going to use this laptop beyond 3 years, even though this laptop is useful, let's say, for 5 years, right? But my policy is that after every 3 years, I'm going to discard this, or I'm going to dispose this in the most appropriate manner. I'm going to use more relevant technology. So useful life for you then from that purpose is only 3 years, and economic life of the asset is maybe 5 years, for example. So there are different parameters, right? So what is the total life? Total life of an asset is actually represented by the economic life of the asset, right? Economic life could be 5 years. What is the useful life? Is the life for which I am going to use it for my business for the purpose of I kind of purchase the asset, and what are my purpose for which I can potentially purchase the asset? Or there are 3 potential reasons I do purchase the asset, whether to use it in the production or supply of goods or services, or for giving on rentals to others, or for the purpose of my own administrative purpose. So I may want to use the asset for these 3 purposes, and if I'm only going to use it for 3 year, 5 year, 10 year, 20 year, depending upon how long I can use that asset, and that has to be lower than the economic life of the asset. The economic life of the asset is only 5 years. Of course, I can't use it for 7 years, right? So I need to determine the useful life based on my own entity assumption. and that is in a way subject to several factors like the expected usage, like wear and tear, like technological obsolescence, like contractual limitations, like my own internal policies or my own repair and maintenance of such asset. All of that put together in a way will help you to determine the expected useful life of that asset, and that is what you need to consider. Now let's look at this example in terms of asset which is available for use, right? So company X in this example purchased a DG set, right, on 1st of January 2020 and places it at its factory unit. The objective of the DG set is to use as a backup in case of power failure. There is no frequent power outage in the locality where the DG set is placed. So essentially, I have a backup equipment, but I'm not likely to use this because there is not expected to be too much power outage. But this is important for me to keep it because I am not able to control the power outage, and if I'm not able to control, I need the backup to maintain my own production, right? Maintain my own production or maintain my own need of power. So the question is that the DG set, from which date you need to start providing for depreciation. Is the date when there's going to be first power outage, and you want to start using it, or the date when it is actually being made available for use. So the DG set is assumed to be available for use on 1st of January 2020, and 1st of January 2020 is when I need to start providing for depreciation, is the depreciation date. I need to start looking at it from that perspective. The 1st of January is what I need to start providing for depreciation for this particular asset. Now again, for me to determine how much depreciation I need to provide for a particular asset, I also need to be cognizant of the residual value, right? A residual value, a very simple example. Again, I talked to you about this example of car. So you purchase a car, let's say you purchase the car for 10 lakh rupees, and you believe that I'm going to use this car for a period of 5 years for your own purpose, or for the purpose of your business. And then the question is that after 5 years, if I were to decide to dispose this vehicle, what is the residual value is what I am likely to get. Let's say if you believe that after 5 years, I'll be able to dispose this for 1 lakh rupees, then this 1 lakh rupees actually becomes your disposable amount or residual value. Then essentially you need to depreciate only 9 lakh rupees, right? Then you don't provide depreciation for 10 lakh, but you only provide depreciation for 9 lakh. And this is also very, very important for you to remember, right? Then only you will be able to compute the correct depreciation charge in any accounting period. So estimated amount obtained from disposal of the asset after deducting the estimated cost of disposal. If there's any information in the question to say that there's a cost of disposal, you need to factor that in to determine your residual amount if the asset were already of the age and in the condition expected at the end of its useful life. So after 10 years or after 5 years, what's the condition of this vehicle going to be for the purpose for which I've already used it, and then I need to sell it. So for example, right, if you are an Ola or Uber of the world, as I said, and you're going to run this as a taxi, after 5 years, you can very well imagine the residual value will be far lower if you were to use the same vehicle for the administrative or your own business purpose, right? Then the wear and tear or the usage of the asset, all of that will be very different if you actually use that asset for the purpose of providing goods or services to your customers. So that's the important, in a way, distinction is what you need to remember. So it is important for you to determine the residual amount. For you to appropriately determine the amount of depreciation is what I need to charge for any particular tangible asset or property, plant and equipment. So I'm going to look at this depreciable amount, cost minus residual value. It is cost minus residual value, and we've already understood how to determine the total cost, right? Once you've determined the total cost, then I also need to determine the residual value. Under the cost model is what is I need to provide for depreciation. Similarly, under the revaluation model, I need to look at the revalued amount and the residual value, right? And residual value is also required to be reassessed at every measurement date. At every measurement date, you are supposed to reassess the residual value. However, in practice, we generally don't see that this residual value is changing at every measurement date. We don't see that in practice. Residual value, once determined, often stays the same through the life of that asset. Unless we have some really information, solid information, which makes, and it is so material that which makes us believe that we need to change the residual amount for us to appropriately determine the depreciation cost in that particular accounting period. So under the cost model, you got to determine the cost, and then you got to determine the residual value, and the net amount is what you need to start charging depreciation. Under the revaluation model, you got to determine the revalued amount, and then you need to continue to determine the residual value, and on which is what you need to charge the depreciation. So what are the methods of depreciation, right? The methods of depreciation is a straight line method. You can charge a diminishing balance method, and you can also use some of the unit method. Diminishing balance method is nothing but written down value method. So these are the most two prevalent method. Is what we see, is what companies do use. And out of the two also, most common method is what we see, straight line method of depreciation. Across the board, we see companies use straight line method of depreciation. Under the income tax law, in India, the companies are required to follow diminishing balance method, which is the written down value method. But for the purpose of Companies Act, for the purpose of accounting standard, we see across the board companies follow straight line method. There are few companies, for their own business nuances, they do follow diminishing balance method or sum of unit method. Again, if I were to look at a large spectrum of companies, most of the companies will be following, straight line method, and very few companies will be following diminishing balance method or the sum of the unit method. So, but the important thing for you to remember is that the standard do not mandate you that this is the method you need to use, or this is the only method you can use from that perspective, right? You have to actually look at the method of depreciation with respect to those 6 parameters which I had explained to you, which is to say that how you're going to use the asset, what is the expected usage of the asset, what is the wear and tear of the asset, what is the technological or commercial obsolescence of the asset, what is my own expected view on the life over which I'm going to use this, is there any legal or contractual restriction on this asset, from that perspective. So you got to look at all of the criteria which are specified, and then appropriately determine the depreciation method to reflect the pattern of usage, from a recognition perspective on depreciation, right? So that's the important thing. So the method what you're going to choose shall reflect the pattern in which the asset future economic benefit are expected to be consumed by the entity, which is what I was trying to say, is that the method of depreciation should reflect the expected economic benefit is what you're supposed to derive or generate from the usage of that asset, and that has to be again reviewed at each balance sheet date. However, again, we don't see too many companies changing the method of depreciation on a frequent basis. We do see some companies changing the method of depreciation, but again, this is not common. That once you've determined, you normally stay the course throughout the period, and if in very limited situations is what we see companies do changing the method of depreciation, from that perspective. Now, if there is a significant change in expected pattern of consuming future economic benefit, then methods shall be changed to reflect the new pattern. Now, the important thing for you to understand here, the change shall be treated as a change in an accounting estimate and accounted for as per Ind AS 8. As a change in accounting estimate, right? a change in the method of depreciation or change in the estimated useful life of the asset or a change in the estimated residual amount or value of the asset, all of these are considered as a change in accounting estimate, and a change in accounting estimate under Ind AS 8 is required to be done on a prospective basis. What does this mean? That if an asset which I was depreciating for 10 years, now in the year 3, I realize that the life of this asset is actually not 10 years. The life of this asset was only 7 years. That means 3 years have already passed. I now need to depreciate it over balance 4 years. So whatever the carrying amount of the asset on that day, I'm going to divide it over 4 years, and then I'm going to depreciate it over balance 4 years. I am not going to do a cumulative catch up for the past period as well and record that as an accounting charge in the current period, because this is not considered as a change in accounting policy, and this is considered as a change in accounting estimate. I think this is very, very important for you to understand, that a change in the method of depreciation or a change in the estimated useful life of the estimated useful life of the asset, or a change in the estimated residual value of the asset, all of these are considered as a change in estimate, which is to be considered to be accounted for on a prospective basis. They are not accounted for as a change in accounting policy, even though if you are changing the method of depreciation, it has actually a component of both, right? The policy and the estimate, so to say. But from an accounting standard perspective, it is considered that that is a change in accounting estimate, and that is required to be accounted for on a prospective basis. So now the example we are looking at, in try and understand some of the accounting nuances, okay? So K2 Limited has acquired a machinery for INR 10 lakh on April 1, 2015. Okay. The machinery residual value is nil, zero, and the management estimate of its useful life is 10 years. So you remember, when you're looking at depreciation and amortization, you got to first make an estimate of the residual value, reduce it from the cost, and then you estimate the useful life, and then depreciate, right? And then you will also, of course, look at the method of depreciation is what you are following. Accordingly, so K2 Limited in this case charges the depreciation of INR 1 lakh using a straight line method. So you know the method here, you know the life here, you know the residual value here, right? So it's easy to compute that 1 lakh is the cost, is the depreciation. Now on April 1, 2019, okay, 4 years after the original purchase, the machinery carrying value is INR 6 lakh because 4 lakh I have depreciated. The management has reviewed the useful life and is of the view that the machinery can only be used for next 4 years, making the revised useful life as 8 years. So total life has now been revised to actually 8 years. And originally I had said it was 10 years, but now I'm saying it is 8 years, and my remaining life is only 4 years in a way. Okay. So now the question here is that how do I deal with this situation, right? It's a change in accounting estimate. So very simple. So my carrying value is 6 lakhs, and then my remaining useful life is 4 years. Residual value continues to be 0. So I'm going to now depreciate it over a 4-year period, and my depreciation amount will go up to INR 1,50,000. So revise its remaining useful life as 4 years as on April 1, 2019. Accordingly, the carrying value of 6 lakhs should be depreciated over the revised useful life, and K2 will charge the depreciation of INR 1,50,000 over the next 4 years. So important thing is change in useful life. Okay, is a change in accounting estimate to be dealt on a prospective basis. It is not a change in accounting policy. It is not considered a depreciation change, whether method, whether life, anything is considered a change in accounting estimate. And when there is a change in accounting estimate, it's always done on a
prospective basis over the remaining useful life. Had this been changed in accounting policy, we would have actually done a cumulative catch up, or we restated the previous period, and so on and so forth. So we're not doing any of that here. Okay, it is considered change in accounting estimate. Because it's a change in accounting estimate, I'm doing it over a prospective period. So my future depreciation changes to 1,50,000. I will not touch anything to my past depreciation. Okay. So let's look at example around subsequent measurement, right? Under cost model, how does that in a way impact from an accounting and reporting perspective? So Reality Limited has purchased an equipment at a cost of INR 20,000, okay, on 1st of January 2017. Now, management estimate of useful life is 10 years. The equipment has a residual value of INR 4,000. So I bought it for 20,000, residual value 4,000. That means how much I need to depreciate? 16,000. Now, after the end of year two, at the end of year two, the management revisits the useful life and revises the same to total 6 years. Okay, assuming no change in residual value. So not at the end of after. So year two accounting is done. After that, I realize that the life is total life is 6 years. Remaining life I revise the same to total 6 years. Remaining 4 years. Okay. So originally I thought it's 10 years, but I now saying it's a total 6 years, and 2 years have already lapsed. Now only 4 years. So what should be the depreciation charge for initial 3 years? Awesome. Okay. So I have to do accounting here for 2017, 2018, and 2019, and this changes happened at the beginning of 2019. Okay, so essentially I've changed, revises my life as to be 6 years instead of 10 years, right? The remaining life is 4 years. So when you look at this, what essentially we are trying to do here, so my year one cost here, so let me just clean this stuff for you. Okay, so I've got all of this now sorted for you. All right. So my year one, year two, year three, which is year one is 2017, 2018, and 2019. Essentially 20,000, cost remains the same. There is no change in the cost. My depreciation is 1,600 is basically because 4,000 is my residual value. So 20,000 minus 4,000 is 16,000 divided by 10 years, right? 10 years is my original estimated useful life. So 1,600 for year one. My year two is accumulated is 3,200, which is 200. Then my carrying amount is 16,800 depreciated. Now here, I'm saying now my life is only 4 years and my residual value stays at same 4,000. So here my depreciation is now 16,800 minus 4,000 is divided by 4. Now my depreciation charge has just doubled, right? It has become 3,200. So that is why it is now 6,400, and my revised carrying value is now 13,600. All right. I hope this is clear to all of you. Important thing is again, this is just kind of impressing upon the point that change in accounting depreciation or estimated useful life or residual value or a method of depreciation, all of that is considered a change in accounting estimate to be accounted on a prospective basis. All right. Okay. Let's look at this example. M&O Limited purchased an asset on 1st of January 2017 for a cost of INR 5 lakhs. The company depreciates the asset at 10% using diminishing balance method, right? Diminishing balance method is another name for WDV, right? So on 1st of January 2020, the management of M&O Limited estimates a remaining useful life of 8 years. Okay, remaining useful life of 8 years, and has decided to follow SLM method, which it believes reflect the pattern of recovery of economic benefits, assume no residual value at the end of its useful life. Now, what is the impact of the revision on the depreciation charge? Okay, so MNO Limited purchase an asset here 1st January 2017, cost is 5 lakh. Okay, so dates are important, amount is important, 10% is what I was following on January 2020. Remaining useful life of 8 years and decided to follow SLM. So I'm changing my method of depreciation. Also, okay, no residual value. Now, what is the impact of the revision? Again, remember, as I said, that it has to be done on a prospective basis. It is considered as a change in accounting estimate. Okay, so looking at the solution here, as per Ind AS 8, a change in depreciation method is considered as a change in accounting estimate, which should be recognized on a prospective basis. So I'm going to first assess what my carrying value as of 1st of January 2020, right? So depreciation charge for the year 1 to 11 will be as follows. So 2017, I did 20% is 50,000. Then it was diminishing balance, right? So again, it's 45,000 and 40,500. For first 3 years, I did WDV. So my carrying value here was how much? Uh, that is 3,64,500, right? 4,05,000 minus 40,500 is 3,64,500. Here now I made an estimate that the remaining life is how much? 8 years. Okay, and that is where, and now I want to change the method of depreciation. So I'm going to then do 364. So my depreciation now for remaining 8 years till the time I again change my estimate is 45,562. Based on the principles of the standard, you're supposed to keep on assessing it at every, in a way, reporting period, so to say. Though we don't expect that you need to have a change in every reporting period, but if you have a change and it can be justified, then it is to be accounted on a prospective basis, right, as a change in accounting estimate. All right. Hope this is clear to all. Okay. So let's try and understand a few bits around with the help of this example on the depreciation under componentization. So we just talked about the componentization, right? With some overhauling, inspection, and all of that stuff. Let's just look at the in computation of depreciation with these componentization as well. So Vikrant Limited, a shipping company, has acquired a ship at a cost of INR 200 crores. The ship has an estimated useful life of 20 years. As per the law, major overhauling is required every 5 years, which at current price amounts to INR 50 crores. Okay. The actual overhaul cost incurred at the end of year 5 is INR 60 crores. Okay. So how much I've acquired the ship at? 200 crore. The useful life is 20 years. The overhauling is required every 5 years. The current estimate is 50 crores. Actual cost is 60 crores. Okay, so we have all the information here. Now, depreciation expense for the year 1 to 5. How will you compute the depreciation expense for year 1 to 5? It is overhaul 50 crore and ship is 150. Total is your 200 crores, right? Depreciation here 10 crore for the overhauling and then 7.5 crore, which is what? How much? 17.5 crores per year is what your accounting charge. Okay. Now, total depreciation for the first 5 years will be 87.5 crores. And the carrying amount of the ship at the end of year 5 will be INR 112.5 crores. Okay, which is 200 crore minus INR 87.5 crores. Now, on this date, if you have incurred additional cost of 60 crores, okay, Now, actual overhauling cost incurred at the end of year 5 are INR 60 crores. The amount will now be capitalized into the cost of the ship, resulting in net carrying amount of INR 172.5 crore net carrying amount. Here we are focusing on. So cost is 60 crore, here it is 150 crore, and then I'm going to depreciate by over 5 years, and here depreciation. So here now here when I look at the total, it has now become 210 crore, and it has here become, my depreciation has increased to 19.5 crores. Okay, that is what is happening here. So accumulated depreciation for year 6 to 10 now will be 97.5 crores. The same process needs to be continued for 11 to 15, and then 15, 16 to 20. By the end of year 20, the capital cost of INR 200 crore will have been depreciated, plus the actual overhead cost incurred at year 5, 10, and 15. All right. So essentially what we're trying to say, that the what overhauling cost you assessed at the beginning, that needs to be de-recognized, and the new cost which you incurred, that needs to be recognized, and also it has an impact on your depreciation cost. And any such change here is a change in accounting estimate to be accounted for on a prospective basis.
Now, let's look at another example, okay, another case study, right? Sigma Limited, a manufacturing company, acquired a machinery for INR 21 lakhs. What is the cost of the machinery? Is INR 21 lakhs. Now, the machinery is expected to have a life of 15 years. The life of 15 years. Sigma is required to have machinery inspected every 3 years, okay? Every 3 years, this machinery is required to be inspected, considering the risk involved to people working on the machinery. The cost which is attributable to inspection at current prices is 6 lakh. So what was my total cost of the machinery? 21 lakh. Now what is my cost of the inspection? Is 6 lakh, right? Now the question we need to deal with, that you acquired the machinery on the previous inspection, which was carried out on 1st of April 2017. Now we are as at 1st of April 2020. When you've actually done the inspection, you incurred cost of 7,50,000 as the cost of the new inspection. Okay. Now the question here for you is that calculate the depreciation as per Ind AS 16 in the financial statement of Sigma Limited for the period 1st April 2017 to 31st March 2020 and 1st April 2020 until 31st March 2023. Okay, so we need to compute this, right? Calculate depreciation as per Ind AS 16, and then we got to deal with this, right? From that perspective. So I'm going to now cover this with the help of this example. Okay, how do we look at the solution? Okay, so step 1, annual depreciation cost. I had 21 lakh, and then 6 lakh is what I had estimated. So again, I'm going to determine this is that 15 lakh and 6 lakh. These are two components of my machinery, right? 21 lakh I got to split 21 lakh I got to split between two, right? 21 lakh I'm going to split between two, and then I'm going to say out of that one component is 15 lakh, right? And the other component is 6 lakh, okay, for which the information is available to me. Okay, and then what is the life of this 15 lakh is 15 years, and the life of this 6 lakh is 3 years. So what is my total depreciation cost here? 2 lakh plus 1 lakh, which amounts to 3 lakh. 3 lakh is my depreciation cost from 1st April 2017 to 31st March 2020, right? Now I have come to 1st April 2020. Now when I have come to 1st April 2020, remember how much is the overall or inspection cost I have incurred? I have incurred 7,50,000. Right? I have not incurred 6 lakh which I estimated. I have actually incurred 7,50,000. Now I need to determine my depreciation cost, which is again the same thing, cost of machinery by expected useful life plus cost of inspection by expected useful life, which is 1,50,000, the same life, 15 plus 7,50,000 divided by 3. So what is my depreciation now, which is nothing but 1 lakh plus 2,50,000, which is 3,50,000. 50,000. My depreciation cost has increased from 3 lakh to 3,50,000. Why? Because the cost of inspection was higher than what I originally estimated, and hence my future depreciation cost is now higher than what I originally estimated. Now this is again considered as a change in accounting estimate, and you continue to account for it on a prospective basis. So this 3,50,000 is what you will continue to account for it on a prospective basis. I think that is what is important for you to understand. So we now move forward. Now a very, very important example is what we're going to cover. This example was, or this question was covered in November 2019 marks. And with the help of this question, actually, we also going to introduce a new concept, right? A concept, this concept is actually in relation. So remember, the primary definition of an asset itself, right? What is an asset? And we're going to cover this more, in the context of, asset, liability, income, expense, when we look at Ind AS 1, right? Which is the presentation of financial statement. And an asset is generally defined as something which is in control, right? Which is something which is controlled by the entity, and you're able to derive economic benefits, right, as a result of that control. So the question many times we struggle, let's say for example, you are doing a factory building, right? You're doing a construction for a factory building. Now for you to actually access the factory building, you are also required to build a road, right? For you to access the factory building, you are required to build a road which is outside the factory premise, okay? But that road is important for you to build, for you to have access to the factory building. Without having the road, you can't access the factory building, okay? So the question, but the road can also be used by anyone and everyone, okay? So you can't put restriction on the usage of that road by any other individuals, okay, or for any other purpose, right? But you need that road also on a mandatory basis for you to access the factory building. Now the question is that the cost which you have incurred on the road, whether that cost is required to be capitalized or whether that cost is required to be expensed. Now what the accounting principles of Ind AS 16 suggest us, that if the cost which you have incurred is required for the purpose of your ability to use the factory building for the manner or the purpose for which it is designed to be used, and you can't use it without having access to this road, and if you have to build this road and incur cost, then you are actually supposed to capitalize this cost of the road as well. And the cost of the road is not a revenue expenditure, but it's also a capital expenditure to be capitalized along with the value of the factory building itself. Now that's a very, very important accounting concept which you need to remember, and that was the subject matter of this discussion, which is M Limited is setting up a new factory outside the Delhi city limits. In order to facilitate the construction of the factory and its operation, M Limited is required to incur expenditure on the construction or development of electric substation. So you are incurring expenditure on the electric substation. Though M Limited incurs the expenditure on the construction and development, it will not have ownership rights. Okay, you will not have the ownership rights on these items, and they are also available for use to other entities and public at large. What does this mean? That you're not able to control. You're not able to control the usage, but it is important for you to construct your building, your factory building, and for your operations, you also need this electrical substation, right? So the question here is that whether M Limited can capitalize the expenditure incurred on these items as property, plant, and equipment, and this is for 8 marks, right? So if yes, how should these items be depreciated and presented in the financial statement of M Limited as per Ind AS? So very simple, for us to understand. India 16, the cost of an item of property, plant and equipment shall be recognized as an asset if and only if it is probable that the future economic benefit associated with that item will flow to the entity and the cost can be reliably measured. Remember the principles of recognition, that there it is probable that there is a future economic benefit and you can measure the cost. That is step number one, that if the recognition principles are met, right? Now, India 16 doesn't prescribe the unit of measure for recognition. So for the unit of measure, you again look at, do I need to look at components? Do I have a significantly a value which is different in life, or which is different, significant in value? Now here, since you do not have the control over the asset, you combine this with your factory building. What constitute an item of property, plant and equipment? Judgment is required. As I said, you got to apply the judgment. It doesn't specify the unit of account and recognition criteria of an entity's specific circumstances. India 16 further states that the cost of an item of PPE comprise may cause directly attributable cost to bring the asset to the location and condition which is necessary for it to be capable of operating in the manner which is intended by the management. So whatever additional cost which I'm going to incur to bring the asset to its present condition and location, that is also allowed to be capitalized. In the given case, the electrical. So what is important for you to write this theory, write this basis, right, in the answer. So just don't jump to the answer just like that, okay? Write the basis of your conclusion. Why are you suggesting this answer, okay? You got to look at the recognition, then you got to apply the judgment, and then you got to say that why we believe that this is required, this is allowed to be capitalized, because this cost is not something which you can avoid to incur. Unless you incur this cost, you will not be able to operate the plant, right? And hence this is an important cost for you to incur. Electric substation is required to facilitate the construction and for its operation. Expenditure of these items is required to be incurred in order to get into future economic benefit from the project as a whole, which can be considered as the unit of measure for the purpose of capitalization of the said expenditure, even though the company cannot restrict the access of others to use the asset individually. So in a sense, even though you don't control this portion, you still supposed to capitalize this, because you cannot use the larger asset without having usage of this asset or without having the presence of this asset. So in a way, you are supposed to then capitalize this. In view of this, even though M Limited may not be able to recognize expenditure as an individual item, you will record this as a part of overall cost of the project. From this, it can be concluded that in the given case, the expenditure incurred on electric substation should be considered as the cost of constructing the factory, and accordingly expenditure incurred on electric substation should be allocated and capitalized as part of the PPE of the factory. And then you're going to provide for depreciation on this on an overall basis. This will not be recognized as a separate component. This is considered as part of the overall cost of the factory, and you're going to determine the estimated useful life. You're going to determine the residual amount, if any, and then on the net amount, which is the cost minus the residual amount, on the net amount you determine the useful life, and then you're going to provide the depreciation. So what is this answer is suggesting, right? Each item of property, plant and equipment with a cost that is significant in relation to total cost shall be depreciated separately, provides that if these assets have a life of item to which they relate, they should be depreciation separately. However, if these assets have a life and the depreciation method of item PPs to which they relate, these assets may be grouped in determining the depreciation charge. Nevertheless, if it has been included in the cost of the PPE as a directly attributable cost, it will be depreciated over the useful life of the said PPE. The useful life of electric substation should not exceed that of the asset to which it relates, and it needs to be presented as part of the same asset class to which it relates, which is the factory. You don't need to present it separately. that's the important kind of an example which we just kind of concluded, and that was part of the examination, right? So understand this concept now. Broadly, we largely done with all of the concept, and we're going to now talk more around the revaluation account, and some more examples is what we will try and cover as we continue to progress in our conversation on this topic. So now I'm going to talk to you about a very important concept. So we talked about how do you look at the subsequent measurement of fixed assets, right? Or property, plant, and equipment. So we said there are two methods, or there are two models for subsequent measurement. One is the cost model, and the other one is the revaluation model. I also said that we don't see the application of revaluation model across many companies, sectors is what we commonly engage, but the cost model is what is being used across the board by all the companies, right? But it is important for us to understand the concept of revaluation model as well. So now over next 15-20 minutes or so, this is an area where we will try and understand all the principles of revaluation model, as to how do you do accounting for revaluation model, how do you do what frequency you need to do revaluation, how do you deal with the depreciation for revaluation of such assets, and what happens if the revaluation is at a higher value, what happens if the revaluation is lower than the existing carrying value, etc., etc. So all of these concept is what we will try and understand in next few slides. So when you look at the revaluation model, the first thing I need to understand is that what is my carrying amount of the asset. Carrying amount of the asset could be the cost of the asset, right? Cost of the asset which you have purchased. So when you look at the cost of the asset which I have purchased, and all other directly attributable cost, and we talked about some of the other costs which all can be part of your capitalization. So you determine the carrying amount of the asset. The scenario could be that you have an upward revaluation. There is an upward revaluation in the value of the asset. Then you got to record the revaluation gain is recorded in other comprehensive income. So what is the meaning of OCI? OCI stands for other comprehensive income. Okay, it doesn't come to profit and loss account. That is important for you to understand. If there is a revaluation gain, it goes to other comprehensive income. However, credit to P&L first to the extent of any revaluation loss for the same asset. If you've recorded a revaluation loss in the previous period, and if that loss has been recorded through profit and loss account, and in a subsequent period you have a revaluation gain, so to the extent of the loss which has been previously recorded, that goes to profit and loss account. Anything over and above will go to OCI. In other words, in no situation the upward revaluation from the carrying amount of the asset will go to profit and loss account. All right, but if it is resulted into a downward and there's a debit to the profit and loss account, in future period of the asset value recovers, then you again recoup that gain from the P&L from that perspective, and we'll try and understand this with the help of few examples as well. Now, when you look at there's a downward revaluation, it's very simple. If there's a downward revaluation is recognized through profit and loss account. It doesn't go through OCI. If there is an upward revaluation, then it goes through the other comprehensive income. But if there's a downward revaluation, then it goes through profit and loss account. Okay, profit and loss account. And that is why, again, one of the reasons we don't see a lot of companies using this method. Okay, because there is no upside in your P&L. There is only downside in the P&L. The debit to OCI first to the extent of any revaluation gain for the same asset. So now let's say previously we have recorded the gain in the OCI, and now there is a decrease in the value. That decrease is also first recouped from the OCI. So it just follows a very intuitive principle, right? So increase in value goes to OCI. However, if previously there was a value was decreased, then you first credit the P&L to recoup that loss, and then goes to OCI again, right? And again we will try and explain this with the help of an example. and if there is any way decrease, it will be charged to the P&L. However, if previously you had recorded an increase, and hence that then the decrease will also first go to OCI and then come to the P&L for the remaining item. Let's just try and understand this with the help of an example. The revaluation surplus may be transferred to retained earnings when the asset is derecognized. Now this also is an important concept. Why this is important? Because generally when you see the revaluation reserve is of no value, right? From a company perspective, you can't do bonus shares, you can't do this, you can't do that. Revaluation reserve, banks don't consider is for the purpose of net worth. It's practically a useless kind of a reserve, okay? However, if you dispose that asset or fully depreciated that asset, then whatever is left in the revaluation reserve, the standard provides a mechanism that you can actually transfer that to retained earnings. Right? And if you were to transfer that to retained earning, then basically then that becomes part of a distributable profit pool of the company, from that perspective. And that's why this provision, enabling provision, is important. Now we will try and understand this increase or decrease business with the help of this example. So let's say the carrying amount here is 20,000 and you got to revalue this at 16,000. Okay. That means there is a downward revision in the value of the asset. So this 4,000 will be debited to profit and loss account and my asset value will go down by 4,000. Now let's say it is further been revalued to 13,000. So I was at 16,000. I further reduce the value to 13,000. Then another 3,000 will be debited to P&L and my asset value also will be reducing by 3,000. So my net carrying amount becomes 13,000. Now take another scenario that instead of reducing it to 13,000, actually it has been revalued at 22,000. Remember, the original cost was 20,000. It was revalued to 16,000. Now let's say this is year 0, this is year 1, and this is happening now at year 2. Okay. Now in year 2, you revalued this to 22,000. Now how do I account for it? So to the extent of the loss which I have recorded in the P&L, I'm going to recoup this loss from the P&L. So debit asset is going to go up by 6,000. So I'm going to bring the asset from 16,000 to 22,000. So that comes to 6,000, and then credit P&L. This 4,000 is nothing but what I had debited here. So I'm going to recoup, and this excess 2,000 is what will go to other comprehensive income. This gain will go to other comprehensive income. OCI stands for other comprehensive income. I'm going to look at it this with the help of another example, right? Let's say the carrying amount, the same carrying amount is 20,000. Now there is an upward revaluation in year 1 itself. So this is again year 0. We are at year 1. In year 1, you've done an upward revaluation at 22,000. Then what do you do with this gain? This gain will be debited to asset and it goes to OCI. There is no P&L business here. Why? Because there's an increase in the value. The moment there's an increase in the value, it goes to OCI. Unless there was a previous loss, which was in this example that I recorded, here there is no previous loss which I'm recording. This is an increase in the value. Increase in the value straight away goes to other comprehensive income. Now there is a subsequent reduction to 18,000. If there is a subsequent reduction to 18,000, then I am going to debit the P&L. So now I was at 22,000, right? I was at 22,000. My total loss is how much now? 4,000. Now out of 4,000, I'm going to recouping this 2,000 from OCI. 2,000 is debit to P&L and 4,000 is the total loss in the value of the asset. Now let's look at another situation. If it is revalued at 25,000, right? There's a further upward increase in the value of the asset. If there's a further upward increase in the value of the asset, that's the gain will continue to go in OCI. So my total gain now in OCI, which is sitting, is 3,000 plus 2,000. So it is important for you to maintain these reconciliations if you are doing fair value or revaluation accounting for property, plant and equipment, because the rules that if there is a subsequent decrease, if it is only going to increase, then you are okay, right? But if there is going to be an increase in one period, decrease in another period, increase in another period, then you have to maintain the reconciliations, right? To ensure that you do the right accounting. So the revaluation shall be done with sufficient regularity. And the question is at what frequency I need to do this revaluation. So a company, let's say listed company, which decides to follow a revaluation method of accounting as a form of subsequent measurement, and you know that company has to do quarterly financial statements. The question is, then do I need to do every quarter revaluation? The answer to that is no. You don't need to do this at every quarter. You got to do this at sufficient regularity. So the frequency actually depends on the movement in fair value. So if you have evidence, if you have reasons to believe that there is a change in fair value, then you need to do it. Otherwise, you got to keep on assessing at every, say, 3 to 5 years, right? At every 3 to 5 years is what you need to look at from a change in fair value of property, plant, and equipment. And ordinarily, right? Ordinarily, we see that the increase in fair value is only on account of land, all land or building, in some scenarios for building as well, but otherwise for all depreciable assets it is rare to see an upward increase in the value of other, let's say, plant and machinery, furniture, fixtures, or vehicles, or computer assets or equipments or things like that. We normally see that there is a downward pressure on the fair value of those assets. Only for land and building there is a possibility that you will see an upward increase in the fair value of the land and building. So the other important point to be considered that the revaluation as an accounting policy choice, you can do this at an asset class level. It is not necessary that you need to do this at the company level, right? You don't need to do this at the company level. You need to do you can do this at the company level also. But what is required that for some asset you may decide to do historical cost accounting, and for some asset you can do this a fair value or revaluation model. So very commonly, if let's say if somebody were to decide to do revaluation model, then ordinarily they will only decide to do revaluation model for land and building as an asset class, and for all other items they will decide to do historical cost method. Or you may only decide to do for land as an asset class to do fair value, or for within land also you may have multiple types of land, you can categorize them into a specified type of asset class and then do the recognition on that basis. So you can actually define the asset class, but once you define that asset class, then you need to do the accounting policy for that asset class on a consistent basis using the revaluation model, provided that's the accounting policy is what you have chosen for that asset class. And then the example could be land and building, machinery, ships, aircraft, motor vehicles, furniture, fixtures, office equipment, bearer plants, etc. So all these are examples of asset class, and you can choose the accounting policy for each of the asset class either at revaluation model or at cost model. But whatever you decide to choose is what you are required to follow on a consistent basis. And we talked about the frequency, and then we also talked about how do you deal with the revaluation surplus or a revaluation loss. If there's a revaluation loss, it goes to profit and loss account. If there's a revaluation surplus, it goes to other comprehensive income. If this revaluation surplus is actually to offset a previously recorded revaluation loss, then to that extent you're going to charge it, credit it to the P&L, and anything over and above will go to OCI, and same goes for in a way revaluation gain. So I think these principles are important for you to understand. We'll try and understand some of this with the help of an example as well. An item of property, plant and equipment was purchased for INR 9 lakh on 1st of April 2019. It is estimated to have a useful life of 10 years and is depreciated on a straight line basis, right? 9 lakh, 1st April 2019, estimated to have a useful life of 10 years and depreciated on a straight line basis. On 1st April 2021, the asset is revalued to INR 9,60,000. The useful life remain unchanged as 10 years. Okay, so you've done an upward valuation from 9 lakh to 9,60,000, right? So on 1st April 2019, the value was 9 lakh. and then after 2 years, when you've done 19, 20, right, and in 2021 is when you've done this valuation, then you realize that the value has gone up to 9,60,000. Show the necessary treatment as per Ind AS 16 for the year ended 31st March 2022. So what are information we have here? We have the cost of the plant, right, or PPE. We have the useful life of the plant, right, which is how much is 10 years. We also know the method of depreciation, which is straight line method. We also have information at that 1st April 2021, there's a revaluation being carried out, and the value revaluation is 9,60,000. The assumption here is that the company has decided to do revaluation model as a model of subsequent measurement.
Let's look at this example on 1st of January 2019. Strong Limited and purchased an equipment for INR 90,000. Strong Limited purchased an equipment for INR 90,000. The useful life of the equipment is estimated to be 10 years, which is not expected to change. Useful life is not expected to change. Strong Limited uses SLM method. Strong Limited uses SLM method for charging depreciation. Strong Limited has revalued the equipment on 1st of January 2021, and the revalued amount is INR 96,000. All right. So let's just look at the question again. I purchased for 90,000, life is 10,000, 10 years, which is not expected to change. Now SLM method, I've revalued the equipment on 1st of January 2021, and the revalued amount is INR 26,000. Okay, all right. It is gonna beyond my cost, and also after a couple of years of depreciation. Interesting. So question is, what will be the accounting treatment for the year end date 31st of December 2021? Assuming, like, I don't have any more information here, right? That basically 10 years continues. Okay. Then we bought it for no residual value. Okay, awesome. All right, let's look at it. So solutions are in two kind of steps, right? Step one, yearly depreciation before revaluation. 90,000 divided by 10 is 9,000. And then for how many years we depreciated? 2019 and 2020, right? For 2 years, right? Which is 2019 and 2020. 9,000 each means 18,000. Okay. Is what we've depreciated. So how much was my carrying amount? Cost minus accumulated depreciation, 18,000, which is 72,000, which I have revised to 96,000. That means I have a revaluation gain or loss of how much? 24,000. Okay. So gain on revaluation of 24,000, which is 96,000 minus 72,000. 72,000 is coming from here, and then 96,000 is the revaluation amount, is the information given. So 24,000 is my revaluation gain or loss. So how much will be my incremental, what will my accounting treatment of the depreciation for December 2021? So essentially now I need to depreciate 96,000 over how many years? Over 8 years. Okay. So essentially what is happening here, I'm going to record for this 24,000 additional depreciation of 3,000. Okay. So revised depreciation for 2021 based on revalued amount 96,000 divided by 8, which is 12,000. My original depreciation was 9,000. So my incremental depreciation is of 3,000 that will be charged to P&L. Remember, the revaluation gain will go to OCI, right? The revaluation gain doesn't come to P&L, but the depreciation comes to the P&L, which you can reclass to the balance sheet, right? As part of the closing entries. In P&L statement for the year ending December 21, a depreciation expense of INR 12,000 is recognized. A transfer for additional depreciation of 3,000 can be made to another element of equity, which will be shown in the statement of changes in equity, right? Which is revaluation surplus debit 3,000 and to retained earnings. So it's a balance sheet entry, but the depreciation charge of 3,000 that will go to profit and loss account. Okay, that's the important and that's the distinction also between existing Indian GAAP and Ind AS 16. The closing balance of revaluation surplus on 31st of December 2022 will be as follows. Okay, 96,000 minus 72,000 transfer to retained earning. Actually, it will be 31st December 2021. All right, will be as follows. Okay, 21,000. Awesome. So let's do this example. Gemini Limited, and this example is around the, can you follow different methods of different measurement model, like the cost of the revaluation model uh, for different class of assets, right? As we were talking about that, generally it is oftenly understood, right? As I was talking, that the property, the land and building, let's say, or the land is one class of asset, building, then you have plant and machinery, then you have office furniture, computer equipments, and so on and so forth, right? But it is also possible when you look at this class of asset, right? It's a narrow, it's not a very wide concept, right? That all buildings will be one class, right? It's not like that. You can actually make within building different class, right? Depending upon their nature and type. Okay, and that's what this example is just trying to illustrate. So Gemini Limited is a diversified business group. Currently, the company owns many industrial buildings, factory godowns, and office buildings in various regions. Now, industrial buildings are situated in the demarcated industrial zones, whereas the office buildings are located in business zones of the city. So again, there is a fact pattern, right? There are industrial zones, there are business zones, and Gemini Limited has elected the cost model for the industrial building, right, and the revaluation model for the office buildings, right? The question is this okay? Is this acceptable, right? Now, as we've been talking, right, this is absolutely fine because these are based on the nature, right, is what we look at, permits an entity to follow either on cost or evaluation model. However, the election of the model should be done on class by class basis, right? Accordingly, the important question here is whether office building and industrial building can be treated as separate class. Now, industrial buildings are different from office buildings with regard to their nature, use, structure, and the location. Try and see it. Nature, use, structure, and the location, and hence can be distinguished from each other. So you got to identify the character of these assets. Therefore, Gemini Limited can adopt different subsequent measurement models for office and industrial buildings, and hence the treatment followed by Gemini Limited is correct and appropriate. However, all properties within the same class should follow same model. Also, separate disclosure for both the classes should be provided as part of financial statement. All right. Okay.
Now the property 2 is another factory building. The purchase price is 20,000. The market value is 22,000. Again, there is an increase in the value. Life is 10 years. I want to follow a revaluation model. Okay. Now the question here is, there's a third property I have, which is a let out building. So we're still looking at the question, right? So I have factory 1 building, I have factory 2 building, now I have factory 3 building, let out building, which the purchase price is 24,000. A market value of this is 27,000, right? So the life of this building is also 10 years, and I want to follow again a revaluation model here for the purpose of doing the accounting. Now the question here is that the property 1 and property 2 are occupied by the Stars Limited, while property 3 is a let out property, right, on market rent. The management presents all three properties as property, plant, and equipment. Currently, I am presenting all three as property, plant, and equipment. The company does not depreciate any of these properties on the basis that the fair values are exceeding their carrying amount, and recognize the difference between purchase price and fair value in statement of profit and loss, right? The difference in the fair value and the purchase price, they also want to record in the statement of profit and loss, and they're also not providing any depreciation, right? Now the question for us is evaluate whether the accounting policies adopted by Stars Limited in relation to these properties is in accordance with the relevant Ind AS. If not, advise the correct treatment along with workings. So important, right? It's a question which was there in your examination. So we need to understand this thoroughly, right? We need to understand this, how to approach this, right? So there, you look at the amount of information which is given to you. There are 3 buildings, right? And there's and then you have a purchase date which is provided to you. Then you have the cost which is provided to you, then your revaluation amount which is provided to you, then the method of subsequent accounting has been provided to you, the useful life has been provided to you, the purpose for which these buildings are being used has been provided to you, right? And then it is saying the management wants to follow, they don't want to provide depreciation, they want to record the increase in change in fair value through profit and loss account. And the question is what management is trying to do? Is it appropriate under Ind AS 16 model? If not, then how do they need to deal with this, right? So now, if you just try and reflect on what all we said, right? We told you that you got to first determine the cost. What is my cost of the asset, right? Then I need to determine that do I have any components in that cost, right? Here we don't have any components, we don't have that information, right? Then I said, do I have to determine the residual amount, right? Here again, I don't have that information for the residual amount. Then I said you need to mandatorily charge depreciation, right, for items which are covered as part of the scope of Ind AS 16. Now, if you see here, the third item which is here, which has been let out, right? If an asset which has been let out to earn rental or for capital appreciation, then under the scope of Ind AS 16, it is scoped out and it is covered under Ind AS 40, which is investment property. It is covered under investment property. Now, that is very, very important for us to remember, right? So if something is covered under investment property, then I will account for it under investment property. Now then, how do I account for it? What is covered under Ind AS 16? We said subsequent measurement, you can do a cost model or you can do a revaluation model. But whatever you do, you got to do it on a consistent basis for the same class of asset. Here we said we have 2 factory buildings. So the question again we have to answer is that, can I do cost model for one? Can I do fair value model for one? Or I have to actually do either cost for both, or I have to do revaluation model for both and in a way deal with it. And the third thing I need to evaluate is that, how do I deal with this change in fair value? If there's a change in fair value, where do that change in fair value will go? And the other thing you also need to remember that under Ind AS 40, you are not allowed to do a revaluation model. So you are prohibited from following revaluation model under Ind AS 40. You are only allowed to do historical cost method under Ind AS 40, but the fair valuation disclosures are mandatory under Ind AS 40, whereas fair value disclosures are not mandatory under Ind AS 16 model. So both the accounting standards are required here for we to appropriately answer this question. So we'll go through the answer in fair degree of detail. So I'm going to look at first step is the classification of asset, right? The property, plant and equipment state that PPE are tangible items that are held for use in the production or supply of goods or services, of a rental, of other administrative purpose. Ind AS property, investment property, if it is a property held to earn rental or for capital appreciation, then for use in the production, or for administrative purpose. So I'm going to look at both Ind AS 16 and as well as Ind AS 40, right? Ind AS 40 only covers land and building, right? Ind AS 40, the scope of Ind AS 40 is only for land and building. It doesn't cover, for example, plant and machinery or for furniture fixture. So if there's a plant and machinery which you're letting out, then it is still covered under Ind AS 16. But if it is a land or building which purpose is to rent out or for capital appreciation, then it comes under Ind AS 40. Now that's the important distinction. So first is that which accounting standard I need to deal with. For factory building, here I'm going to deal with this under Ind AS 16, and for the let out property I'm going to deal with this under Ind AS 40. So given fact, property 1 and property 2 are used as factory building, therefore classification as PP is correct. However, property 3 is held to on rental, hence it should be classified as an investment property. Classification as PP is not correct. Property 3 shall be presented as a separate line item as investment property as per Ind AS 1. So that's one part of the answer now which is done. Now when you look at the valuation of the asset, I talked about that you can do valuation of the asset based on either the cost model or the revaluation model, right? Now the revaluation model is not permitted for investment property, okay? For investment property, you can only do cost model, and we will try and cover this in more detail when we will talk about Ind AS 40, right? But for here, Ind AS 16 states that entities shall choose either the cost model or the revaluation model as its accounting policy and apply that policy to an entire class of asset, right? Ind AS 16 states that if an item of PPE is revalued, the entire class to which this PPE belongs shall be revalued. And we said that Ind AS 40, the revaluation is not allowed, right? You have to do cost model for investment property. Since property 1 and property is used as factory building, they should be classified in the same category, and both the property should be valued either at the cost model or the revaluation model. In the property 3, investment property, there is no alternative here. You can only do cost model, and there is a mandatory requirement to do fair value disclosures for investment property, and there is no fair value disclosure requirement is mandatory for properties which are accounted for under Ind AS 16. Now, if there's a change in value on account of revaluation and treatment of that, right? That's the step 3 is here we are looking at. And when you look at this, as I said, if there's a change in value and if you're following a revaluation model, the increase in value will go to other comprehensive income, not to profit and loss account. Okay, here they were taking it to profit and loss account, so that also was wrong accounting. So you got to mandatorily record that increase in fair value to other comprehensive income. Increase as a result of revaluation recognized in other comprehensive income and accumulated in equity under the heading revaluation surplus. Increase shall be recognized in P&L to the extent it reverses a previous recorded revaluation loss of the same asset, right? So again, this is important. Accordingly, the revaluation gain, what we had in both the assets, if I do revaluation model, that will go to other comprehensive income under the heading of revaluation surplus. And then depreciation, it is mandatory for me to record the depreciation. Even if my fair value is higher than my carrying value, I am still required to record the depreciation. Accordingly, Star Limited is required to depreciate these properties. All 3 properties are required to be depreciated, okay? Unless it is land. Land is the only asset class which is not required to be depreciated. As I said, every other asset class we are required to depreciate it. There are certain type of intangible assets where also you can possibly have an accounting policy. You can possibly do that. You may not depreciate them. Why? Because you're not able to assess the useful life of those intangible assets, right? So it is not it is not that they don't have a life. It's not infinite life. It's actually indefinite life. Because it's indefinite, you're not able to determine it, and hence you're not supposed to then amortize such intangible assets. But for all tangible assets except land, you are supposed to depreciate them. You are supposed to depreciate them. So I'm going to then look at rectified presentation in the balance sheet. So I'm going to do this in the balance sheet as per the provision of Ind AS 1, Ind AS 16 and Ind AS 40. I'm going to look at all 3 of them. Balance sheet as at 31st March 17. Assets, property, plant and equipment. So the 30,000, then I'm going to record the depreciation. The net value is 27,000. For property 2, it is 20,000. I'm going to record depreciation of 2,000. The net value is 18,000. My investment property, so my total value here is 45,000. This is assuming what? The cost model. This is assuming the cost model. If I were to do the cost model, this is what I would have done. My depreciation would have been 5,000, and my this is 45,000. Property fair value is 27,000. And then, however, this is the disclosure, right? This is only disclosure. You are not allowed to do a fair revaluation model for investment property. Okay, the cost is INR 24,000 minus the depreciation, again 10 years useful life is 24,000, and 21,600 is my carrying value of the investment property. Now if I apply the revaluation model, then again how do I account for my factory building 1, my factory building 2, right? And that's where the carrying value will be 32,000 and 22,000, and it will be at 54,000. There will be no change in the depreciation, at least for that year, right? For that year it will continue to be 5,000. Now my depreciation cost will change for the subsequent year, because on the subsequent year now my base will become 54,000 for me to determine the cost of the depreciation, for me to determine the depreciation charge. In my property, investment property, there's no change here, right? Why? Because I am not allowed to do revaluation model for my investment property. It has to always be at cost basis, historical cost basis. So all of that is what you need to understand and determine, and then appropriately disclose. So my revaluation reserve, which goes into other equity, is 5,000, which is 32,000 minus 27,000. My property 2 is 22,000 minus 18,000 is 4,000. So how much goes into my revaluation surplus is 9,000, right? Now this 9,000 goes and sit into my balance sheet in the other comprehensive income as part of statement of changes in equity. It doesn't come into my profit and loss account. It gets into my extended P&L, from that perspective, on which I don't get the any EPS, etc. So this will be recorded as 9,000, which will impact my future depreciation, but that is not required here for me to consider as an answer, right? Now we're going to move to another concept. So we've talked about several concepts, right? We've talked about several examples in relation to how do I deal with property, plant, and equipment. We moved in terms of from the entire standard, we started with the scope, right? So what is covered as part of property, plant, and equipment, and what is not covered as part of property, plant, and equipment? We said either it's an investment property, if it is for held for sale, or if it is for exploration assets, it is mining assets, if it is an intangible assets, they are not covered as part of Ind AS 16. They are to be dealt in other specific standards. Then we said if it is a property, plant, and equipment, it's a tangible item, then I need to record that as my asset, right? Now, when do I need to record that as an asset? If the benefit of this goes beyond one accounting period. Okay. Now, for what purpose I can use this? I can use this either for the administrative purpose, or for rentals, or for production or supply, or for rendering of goods and services in my own business as a factory unit, for example, or plant and machinery, for example. For rental, for example, it's a vehicle which I'm giving it on rent to others, for example. If it is an investment property like land or building, then it is, and the purpose for which you're using it is for earning rental or for capital appreciation, then it has to be accounted for under Ind AS 40, not under Ind AS 16. Or if you're using for administrative purpose, then you account for it under Ind AS 16. Then we said you got to determine the cost of the asset, right? Now, what all goes inside the cost of the asset is the purchase cost is what you need to look at. Then you need to look at the directly attributable cost, and then you got to look at the other costs, which are your restoration cost or asset retirement obligation. All of that is what you look at, and we covered several examples, right, to explain you all those concepts. Now, once you have determined that how much is I'm allowed to capitalize, then I said, you got to do it. Then we talked about the concept of componentization, right? Once I have determined to capitalize, and do I need to bucket them into different category? And we said you got to bucket them into different category only if the value of that component is significant, the life of that component is different than the main asset in itself. And then we explain this concept with the help of different examples, and most common example we see is the major inspection and overhaul in the context of the ship, or an aircraft, or it could be, or any other asset class, or which there is a significant component, which is a life which is different than the main asset itself. We picked up several examples, and then we said if the total cost of the asset is 150, the value of the component is 15, you're going to capitalize them, as 135 and 15, club them together for the purpose of presentation, but depreciate them separately, and the accounting charge will be different. Now, then we said when you are doing the replacement of those assets, which were capitalized in the form of a component, if they meet the requirement of capitalization. And when do they meet the requirement of capitalization? Is to say that this cost can be reliably measured, and there is a probable benefit which you can derive as an enterprise from the use of those assets. So both these conditions are met, then you capitalize them at the revised value and then depreciate them over its remaining useful life. And then we talked about the whole concept of depreciation, right? How do you depreciate? When do you depreciate? What are the methods of depreciation? How do you determine the estimated useful life? All of that is what we talked about, whether you depreciate using straight line method, written down value method, or sum of unit method. And then we said why you depreciate based on expected usage or pattern, wear or tear, commercial or technological obsolescence, based on your company owned philosophy, based on contractual or legal limitations, or other factors as in a way may be relevant from the purpose of that particular asset. You're going to then depreciate it over its useful life. You also need to determine the residual value. You need to determine how much to depreciate and what is the accounting charge in any accounting period. And then we said that if you are going to change your method of depreciation or your estimates of useful life, then all such change are required to be considered a change in accounting estimate under Ind AS 8 and to be applied on a prospective basis. That's a very, very important concept which you need to remember. A change in method of depreciation is considered a change in accounting estimate. Now we move forward from there, and then we talked about another concept, which was to say that, which was also covered in one of the examination, is to say that if you're building an asset, right, to have access to the main asset, which is, let's say, example of a factory unit, and I need to build a road to get access to the factory unit, but that road is actually can be used by many people, and this in our example was a substation, for me to have access to my factory unit. Then how do I deal with this electric substation? Is that cost I'm supposed to capitalize or expense? And we said that if this cost is necessary for you to incur to derive benefit from the main asset, then you need to capitalize this along with the part of the main asset. And again, how much to capitalize, how to depreciate, all of those principles is what in a way we talked about is what you're supposed to follow. And then we talked about the accounting model from a subsequent measurement perspective is the cost model or a revaluation model. And we talked about how do you deal with revaluation. And then several examples is now in a way what we talked about. And then we also picked up an example which was not again covered in examination to say that if a company is following an accounting which is not appropriate, how do you advise them as to what accounting they need to follow under the model of Ind AS 16. And all of that is what we covered in great degree of detail. Now I'm going to talk to you about derecognition of property, plant, and equipment. So when do you derecognize? A carrying amount of an item of property, plant, and equipment shall be derecognized when you have disposed it, right? When you have disposed it, or when no future benefits are expected from its use. So when you have disposed it, derecognize it. Or when no future benefits are expected from its use, you got to derecognize it, right? If either on disposal or when, that means you got to discard it, right? It is of no use. If it is no use, you got to derecognize it. Any gain or loss arising from the derecognition between carrying amount and the net proceeds from the disposal is required to be included in profit or loss account when they are derecognized and not considered as revenue, but they are actually determined as per the principle of Ind AS 115. Right? You've got to apply the Ind AS 115 to understand the timing of the recognition, amount of the recognition, but they are still considered as a gain or a loss in your P&L. They are not considered as part of your revenue. So when an entity routinely sells assets to held for rental, it transfers them to inventory. When they cease to be rented, the proceeds from such sale are treated as revenue. a very unique example, right? That if you were to move them to inventory and any sale of inventory, that has to be recognized as revenue, but very, very uncommon. We don't see this, commonly, from that perspective. Let's look at another example, which was again covered in November 2018 for how much? 8 max. The question is, on 1st April 2011, XY Limited purchased some land. Ensure that you're looking at taking note of all of these dates, right? These dates are very, very important. XY Limited purchased some land for INR 10 million, including legal cost of INR 1 million, right? Included in 10 million. For construction of a new factory. Construction work commenced on 1st of May 2011. XY Limited incurred the following cost with respect to the construction. So what are the costs which I have incurred? Leveling of land 3 lakh, purchase of construction material 6 lakh 8,000, construction worker employment cost is 2 lakh rupees per month, directly attributable overhead is 1 lakh rupees, 50,000 is the allocated overhead. Allocated overhead, you remember allocated overheads, right? They're not allowed to be capitalized. So allocated overhead, we will not allow them, right? Then income received by temporary use of factory spaces as car park during the construction period, 50,000. Cost of relocating employees is 3 lakh. Opening ceremony cost 1,50,000. So the question is, the construction was completed on 30th of November 2011. When I've started construction, I started the construction on 1st of April, right? When I have completed the construction on 30th of November 2011. But the production began on 1st of February 2012. So I completed the construction on 30th of November, but my production began on 1st of February 2012. What does it mean? Right? That means the asset was available for use when? 30th of November. Remember this. Again, we talked about this, right? The overall useful life of the factory is estimated 40 years from completion date, right? From the date of completion. What is the date of completion? 30th November 2011. Date of completion is 30th November. Date of completion. Okay. However, it is expected that the roof need to be replaced 20 years after the date of completion. Okay. Roof, I need to replace 20 years. The cost of replacing the roof is 30% of the total cost at current price. So what is the cost of the roof? 30% of the cost at the current price. All right. Now, this is what we have. This is what we have. Now, at the end of the 40 years, XY Limited has a legal obligation to demolish the factory. I also have a legal obligation to demolish the factory and restore the site to its original condition and location. All right. It is estimated that demolition cost after 40 years will be INR 20 million. 20 million will be the demolition cost. Now, you got to again look at the discount rate, 8%, the present value of 100 payable in 40 years. So the discount rate of 8% is INR 4.6. All of this information is provided. The construction was again partly financed by a loan of INR 17.5 million taken on 1st of April 2011. The loan is taken at an annual rate of 6%. XY Limited received investment income due to temporary investment of funds of INR 100,000. What is required here? Compute the carrying amount of the factory in the balance sheet of XY Limited at 31st of March 2012, right? We started with 1st of April 2011, completed the construction on 30th of November 2011, started the production from 1st of February 2012. I need to compute my balance sheet as of 31st of March 2012. Explain your treatment of all amounts in your solution. Again, you got to be detailed. You got to be detailed in your solution and approach. Give as much information what you understand in relation to this question. Structure it properly as you are trying to draft your answer, right? And now look at, first I need to determine that what is my cost, which I need to capitalize. Okay. So the land, which I purchased 10,000, which is 10 million. I'm going to capitalize that. Preparation and leveling, capitalize that. Material cost, direct cost of construction, which is 6,080, I'm going to capitalize that. All this information is provided. Then I'm going to look at the employment cost, 7 months, which is April, May, June, July, August, September, and October. 7 months, right? Because 1st November is done, right? So 7 months is what I'm going to capitalize. So whatever was my cost of employment, multiply, which is 200 into 7, right? I'm going to capitalize that. And then I'm going to look at a direct overhead. Again, direct overhead is 100 per month. So 100 into 7 is what I am going to capitalize. The allocated overhead is not allowed. Income from parking, not to be considered, right? Income from parking, not to be considered. Then I'm going to look at relocation cost, not to be considered, right? Opening ceremony cost, not allowed to be capitalized, okay? Finance cost, right? The information which is provided, I borrowed 17.5 million at the rate of 6% per annum. So I'm going to compute how much my interest cost for 8 months is 700. My borrowing cost for 8 months is 700, okay? And then I'm going to look at adjusted against capitalized borrowing cost is 100, right? And the demolition cost is present obligation to be capitalized, which is 20 million. Remember the 20 million, which is to be done at the end of the 40 years. And we got a present value information is 0.46. 20 million into 0.46 is 920. Now, sum total of all of this is 20,000. That is your total cost, which I need to capitalize. Okay. All right. So now the total cost. Now it is important for you to understand that the interest is capitalized for 8 months and the total cost is 20,000. Now why interest is capitalized for 8 months here? So the interest was borrowed, the money was borrowed on 1st of April, right? So April, May, June, July, August, September, October, November. The construction was completed on 30th of November, right? So for 8 months, and then I'm going to adjust this 100, which I generated. So in a sense that if there was a surplus fund which I parked, any money which I generated, that is to be adjusted. And we're going to cover this in more detail when we talk about the borrowing cost as a concept, right? And how do you capitalize the borrowing cost and things like that. Then we'll discuss the borrowing cost standard. Now that is one, and when you looked at the employment cost and other direct overheads, that was considered for 7 months. Why? Because we started the construction from 1st of May, right? So May, June, July, August, September, October, November, for 7 months. We did the overheads as well as for employment, and that's how the total cost of construction comes to be 20,000, or from that perspective, 20 overall 20 million. So and then we move forward to determine the depreciation, right? So depreciation, I need to compute the land. I don't need to provide any depreciation, right? So my depreciable amount is 10,000. So out of 20, 10,000 was the cost of the land. So I'm going to deal with 20,000 was my total cost minus the cost of the land, right? As I said previously, land is not required to be depreciated, okay? So if you have that information available, make sure we don't need to depreciate the land. That's not required to be depreciated. So on 10,000, you're going to depreciate it. You have the information on useful life. What was the, and then you have the roof, right? Remember the roof. Roof said the life of the roof is 20 years. And what is the cost of the roof? Is 30% of the total cost. So I need to determine this. How much is the depreciation? So I'm going to first determine the depreciation on roof is nothing but out of 10,000 of 30%, right? Into 1 by 20 for 20 years into 4 by 12, which is what? December, January, February, March. There are 4 months, right? For 4 months, I'm going to provide on 10,000 of 30%, which is what? 3,000, right? 3,000 divided by 20, right? 3,000 divided by 20, which is how much? 150, right? 150 of 3,000 divided by 20, right? How much is that? Let me do it quickly. 3,000 divided by 20 is equal to 150, right? And then 150 into 4 divided by 12, right? Equals to 50. So that's what comes to 50. Okay. Depreciation of the remaining portions, out of 10,000, 3,000 is now allocated to the roof. That means 7,000 is the remaining portion. That life of that 7,000 is how much? 40 years, right? 7,000 divided by 40, that comes to 175. 175 again divided by 12 multiplied by 4, that comes to 58.33. Here it is written as 58. The total depreciation is 108. And what was my total carrying value? Was 20,000. 20,000 minus 108 is 19,892. That is what my total carrying value. Right? Make sure your answers are as detailed as possible, but it has to be very comprehensive. Remember to take cognizance all the dates, right? It's important for you to take cognizance of all the dates. Otherwise, it's fairly simple for you to answer. There's no complication in computation. If you remember the dates, if you focus on the information which is given, the purpose for which the information is given, you will be able to provide the right answer. Let's look at the quick revisit. We talked about all of this. Subsequent measurement, you have two models, cost model or revaluation model. You can depreciate basis the useful life. You got to be careful of the residual amount and the depreciation methods. Again, it can be straight line method, WDV method, or sum of unit method. Revaluation method, the revaluation surplus goes to other comprehensive income. If there is a loss, then that loss goes to profit and loss account. But if there's a previous gain, then you can recoup, adjust it from that gain, and the balance goes to loss account. If there's only loss, then it anyway goes to profit and loss account. The depreciation on the revalued item also goes to profit and loss account. However, you are allowed to recoup the extra depreciation which you have charged from the revaluation surplus and transfer this to retained earning. From that perspective, and you got to de-recognize your property, plant, and equipment at the time of sale. And when you de-recognize, when you're disposing, or when you don't expect to generate any future economic benefit. So that is what is broadly is give you a good perspective on Ind AS 16. Remember all of these concepts, focus on the information, what we've talked about, and you will be able to appropriately address this. Now we're going to talk about disclosures. Simple principle under Ind AS when it comes to disclosure is disclose, disclose, and disclose. Disclose appropriately, disclose the methods of measurement, disclose the method of depreciation, the useful life, gross carrying amount, accumulated depreciation, reconciliation of the carrying amount at the beginning and at the end of the period, comparative information, existence and amount of restriction on title of assets, property, plant, and equipment which are pledged as securities, amount of expenditure recognized in the course of construction, contractual obligations, all of that is what you need to disclose. If they are revalued asset, effective date of revaluation, carrying amount of each class of revalued PPE, the cost model has been applied, whether an independent valuer was involved, revaluation surplus including movement and any restriction on distribution of balance to shareholder, all of that is what you are required to disclose. And now, if you were to look at the key differences between Indian GAAP and Ind AS, I mean, there's a lot of this because the Indian GAAP has also been revised recently, and a lot of the similarities have now been achieved between the Ind AS framework as well as the current Indian GAAP now. If there are fixed assets retired from active use and held for sale, then Ind AS 105 provides the accounting guidance here. The Ind AS 10 gives you the accounting guidance, for such assets. And similarly, the stripping cost in production phase of a surface mine, AS 10 does not give you any guidance, whereas the guidance is provided in relation to Ind AS 16, and you got to deal with them appropriately. So with this, we're going to come to an end of Ind AS 16, and now we're going to talk to you with many more examples, right? We're going to cover this with more examples and a lot of these practice session. Again, key for your success is that you got to practice. You got to practice. You got to look at the problem, look at the problems which are there in your study material, look at the problems which come in your examination, and you got to practice. Write those answers. Just don't memorize them, right? You got to literally write how you're going to approach the answer to each of these questions, and that is what will help you, eventually when you're going to appear for this, for the purpose of your examination. And beyond examination, whatever we've talked to you today, all of these are very relevant and important, because property, plant and equipment as a concept is going to be applied in any company you're going to work for, or even if you're to start your own business. So you've got to think about what is the capital expenditure, what is the revenue expenditure, how much to capitalize, when to depreciate, how to depreciate, what models of capitalization I need to follow, subsequent measurement I need to follow. Then once I have disposed the asset, how to dispose that, how to account for that, and then what is it I need to disclose as part of my financial statement. All of that is what we talked about, and you try to get this inside your head. You look around assets, what you see, and you think about when this building was being constructed, what type of costs are being incurred, and then is this cost is allowed to be capitalized? If yes, then now this building has to be depreciated. You got to depreciate this building over its useful life, right? How do I determine the useful life of this building? How do I determine the residual value of this building? So on and so forth. All of that. How do I look at the componentization, right? All of that is what you got to keep on thinking, and again, practice. The more you practice, the better you will become in terms of your deep understanding of accounting standards. With this, we've come to an end a session on property, plant and equipment, and I'm going to request my colleague Amit to take you through with more questions and kind of more practice around Ind AS 16. Thank you.